Welcome back, guys. This is the part two. My name is John Hart, and you are watching the lesson five, part number two. We're gonna go deep dive on the options, rocket mortgage, how we can hedge your position by using a cover call when the market is going downturn. So we're gonna go deep dive on the rocket mortgage. We're gonna cover what happened and what you should do when the market against you, or the market, basically the bear market, come in, right? Liquidation, correction, whatever you call it, and how you can use hedging your position from here. So in this video that I'm recording here, I'm gonna share the real scenario that I have with Rocket Mortgage. I own a share. I purchased shares, and apparently within the same day, it just basically against me, and I have to decide if the market's gonna pull back. Then what should I do, right? Should I cut loss? Should I buy more, or should I hedge? Either you buying puts, option puts, and you're hoping that rocket will go down more, or you basically selling call. So that will be the scenario that I want to cover. I created a PowerPoint here for everybody basically to see. I'm going to share my screen. Let's go to desktop number 2. And we're going to go step by step. And then after that, we go to the last 4 slide that has the real scenario play. So the topic today is, what do you do when the market basically against your market downturn? So we're gonna talk about hedging your position. We will not talk about cutting loss, because cutting loss is pretty straightforward, right? I mean, if you lost 1 point and then you have 500 shares, then you're losing $500. So that's kind of the decision that you have to make if you want to cut loss. My philosophy, if you have a very good fundamental company and you are looking at the liquidation or the correction in the short term, which is 2 weeks, 1 week, or maybe a month correction, then you can hedge your position. I mean, that would be the other way, rather than just cutting loss. But of course, if you have limited fund, which is I'm gonna also talk on this recorded video, then you gotta have to have consideration, right? You don't want to use, let's say you have $10,000 capital to invest or to play with the stock, then you buy 10,000 worth of rocket, everything in one bucket, which is a no position at the beginning, right? That's against my philosophy at the beginning. If you have that, then you do, buy 5,000 worth of the stock, or maybe 2,000. Then after that, if it's going down, you can buy more, and you can also hedge it. Remember, when you hedge, you require margin as well. So you gotta have to consider that as well. All right, we're gonna go to second slide, hedging with options. So I don't know how many of you basically play with option. If you don't know anything about option, this is something that you want to learn, because I think it's very good for you to know option. The other thing that I like about option is you also have an option, right? Option is a cheaper play. Considering like you like a insurance company, everything based on premium, extrinsic value, intrinsic value. So let's say right now, I don't know, maybe a good scenario that you are 30 years old, or you're 40 years old, right? You're paying a life insurance, a term life insurance. You're paying, I don't know, $500 every month, every year, or every month, right? And then let's say if you don't die the next year, what happened with your options or your insurance that you pay? Expire worthless, right? So that's technically the same thing with options. You're betting that the stock or the company price will go to certain value or certain price. And what happens if it doesn't go to that certain value or price? Then your option premium that you pay, it will expire worthless. So that will be the downside of option, because considering you're paying premium. Now, of course, if you are a speculator and you know, or maybe you know insider, I'm jumping ahead here. I'm gonna go to third slide. If you're jumping ahead and maybe you know there's an insider information, right? Um, hey, somebody say that, hey, maybe a CEO or maybe a family which is against the SCE, they know that the company will have a deal with certain XYZ company, and for somehow they do have a leak information. Don't ask me how. Then you know they're basically betting the company, hey, this stock will explode and it will go up 10 points. Then it's good to play with option, because eventually option price will explode exponentially. So that is a good thing to know. And this is also where the smart money, right? Where people knows where the information. You can also check the unusual activities and the dark pool order flow. So those are the good source, I would say, to find out where the big money or the smart money come in. Now, for speculation, if you just buying option for speculation, most likely you will lose money, because you're just betting and you don't have any information or when the date, because those are just a speculation. Most likely, like I said, if the stock doesn't go up to X dollar that you are betting or speculate, then the option price the premium will go down in value every single day. Okay, that would be the con right here. Theta is burning every day. If you don't know what's the Greek of option, you should read it. There's a theta, gamma, delta, right? All that stuff. Now the instruction value or instruction premium value is going down every single day. So it's not really a good play if you just want to play a directional option play. That's why I choose as an option trader to sell it, because 80% of the option play, if you just buying call or buying put, let's say if the market against you, you are losing money completely. So it's not really a good play if you just a directional option play. If you're buying, okay. Now, if you're selling, you remember the concept that I gave. You are paying when you play option. You are paying the premium to the life insurance company. Now, the life insurance company is the seller of the life insurance. Now, remember, each transaction in Wall Street is recorded, right? There's always a buyer, regardless if you buy 1 share, 100 share, 1,000 share, there's always a buyer and a seller. Now, if there's a people that buying option, there's also people that selling option. Now, I tend to choose to be on the seller option, because why? If those people, especially the speculator, if they don't make money, and let's say they're betting wrong, I'm making money every single week, every single month, or whatever the calendar that I choose to play with, selling the option, right? Then this is where you also see there's a life insurance. They're making money every single day. Of course, there's gonna be people die too, right? And then eventually they have to pay for whatever the insurance coverage on the terms. So, but if you look at the statistic, 80% of the people that playing option, especially directional option, they're losing money. So the seller that basically collecting 20% every single day, right, or every single week, then of course, if there's any incident, then they pay out that 100% eventually. So that's kind of the way how I put option is. Now, let's go to the play scenario. Any questions so far? Let's see, do we have anybody else that waiting on the...
I'm good.
You're good? Let me check if there's anybody else that waiting on the waiting room and I haven't unmute them. Okay. I think we're all good here. All right. So in this real scenario, Rocket Mortgage, I own the share. I bought the stock 21.50. Okay, this is the average price for 500 share. Now there is 3 scenario what will happen with the stock, right? The stock goes up, Rocket will go sideways, or Rocket go up, Rocket go sideways, right? And you're hoping basically the stock will go up and Rocket basically go down. Now the question is, what would you do? Cut loss, hedge, or buy more? Now I tend to choose 2 out of 3 in this scenario. If the company is good, like I mentioned earlier, I will not cut loss. For example, Apple, I will not cut loss. I will prefer to buy more because company has a good foundation. Company will not go bankrupt anytime soon. Now, I also will choose hedging. Now, there's 2 types of hedging. You can buy put, expecting Rocket will continue going down. Then your put option value will go up, right? Then that will profitable for you. At least you can hedge the losses that you have on the Rocket share. I do not choose to buy put because, like I mentioned earlier, most of the directional option play will lose money. If, let's say, I'm buying Rocket, I don't know, $19 put expired next week. Now, as you know, Rocket, if you watch the, what is it, the thing or so right here. Let's go to Rocket, right? On Thursday and Friday, Rocket, it only goes to 1936 and then it bounces up. Now, if I hedge my play here, buying put over here, then yeah, I will make money if I sell it, right? If I sold it. Remember, the key is you have to sold it in order to make a realized gain. If you're just making money on unrealized gain and you never sell it, and now it's against you, now it's going back to 21 and $20. So that means you're technically losing money because remember, the Theta is burning every single day. Hey, welcome, Taka. So you're joining a little bit late, so we're basically covering the slide number 4. If you I shared the slide as well last night, so if you
Okay. Yeah, I watched the video. Hey guys.
yeah, just watch a video, and then this is also recorded, so you can always feel free to go back again to watch the first 15 minutes.
Yeah, nice to meet you.
Yeah, nice to meet you. Welcome. All right, so if you basically buying put, and let's say if you don't sell it here to hedge it, and you don't sell it, you're gonna be losing money because remember, Theta is burning up every single day, right? So that means, let's say you're buying for $1, now maybe it's worth 90 cents. So you're losing 10 cents per whatever the contract that you purchase it. If you hedge it by buying put, now I choose a different way. I choose to be the seller of the call, right? I become the life insurance because if those people that betting, let's say betting Rocket will go up and it will not go up and eventually just go sideways, up and then go down, up, go down, then technically I can collect that premium free and clear. Now let's go back to that slide again, right? Now we are on the slide number 5, if you're just wondering. Now this is option play. Each trade, regardless call or put option, there will be buyer and seller. I already covered this. Each transaction is recorded. Buying put, you are expected Rocket to go down more, so you will make money in the option put. So the price will go down as the stock, I'm sorry, the price, option price put will go up as the stock go down. Now, Selling call, you are expecting rocket to go down or sideways up, okay? As long it doesn't breach your call strike, you're collecting the premium free and clear. I'm going to cover this on the slide number 6 and 7. Okay, let's talk about this. So the strategy that I'm using is called cover call. Okay, selling option require broker approval. So you need to approve if you don't have access yet. When you apply to able to buy and sell option, they only give you like level one approval. So that means you can only buying directional call or directional put. So make sure when you apply, you need to tell them that you have 10 years of knowledge. Doesn't matter if you use it or not, you need to have all level unlocked for you, okay? Because eventually if you need to use it, it's already there for you. Now, the best way to learn option is to choose and open the paper trading. Paper trading means the fake account. So, and then you can put virtually 25,000, 30,000, 100,000 just to play around with the strategy. So at least you know what kind of strategy that you have, just in case, let's say if you want to play with the real money, you already know the skills that you have with the option, right? Now, if you don't know, 100 shares equal one option contract. So on Wednesday, I bought 500 share of Rocket. So that means if I choose to sell sell option, call option, so that means I can sell 5 contract, okay? Now, any questions so far?
When you sell the option, how far out do you usually sell?
Good question. This is what we're gonna cover on slide 8 all the way to slide 12, okay? You're technically thinking forward, which is I like it. The way how I see it is really depends on the technical chart, okay? If the technical chart is showing me, hey, this is just a minor liquidation or minor correction, and there is a major support below, let's say, let's take a look at the Rocket here. Okay, Rocket basic support, the last uptrend support is $22.30. Okay, we did hit that and then it bounced up. And then of course, you know, as you know, the market basically in the past couple of days has been going down lately. Now that support 22.30 broken, right? And that's where I start buying that lower at 21.50. Now, as you know, in technical chart term, if the support is broken, now it's become resistant. The IPO day for Rocket is at $18. Now, $18 also consider another support because most of the big major hedge fund, they will support this number, right? They don't want to lose money when they, well, technically it's still in the lockdown period, but eventually 60 days or 90 days when they open, when they want to sell it, they don't want to lose money. They want to make money as much as they can, right? So now 22, now we're talking about resistance. 22.30 last support become resistant. Now 20 simple moving average is at $24 and it's curving down. I'll show you on the technical chart here. Okay. Here is the daily chart. Are you able to see the screen?
Yes.
Yeah.
Okay. Now I have a thing or swim here, just to be sure I'm not making the same mistake that I recorded on the part 1. All right. So in here, we know the IPO day, $18, and then it went down to 1750, 1740-ish low, right? And we go up. Now we're making a low and high, and then we bounce up again. and then we go up to 34, which is the highest that we ever go. Then when we have earning, it just plummet. Earning is super great. So I think it's just that it's super overbought, and then people like start dumping and taking profit. Now I drew an uptrend channel here, right? This is the last support. This is the last support. Now I need to move. Maybe I need to move this here. Activate drawing oval. It's right here. You get the idea. Now this is the last about 2230, 2240-ish, right? And then we bounce up and then we broke that. Now this is a support and it become a resistance because we are below that right now. So 2230, right? That's gonna be a resistance. If Rocket will go up on Monday, that will be the level that Rocket will try to fight. Now also the blue or the teal color right here that curving down, this is called the simple moving average. It's 20 simple moving average and it's curving down. Now I choose to sell because I think if we're gonna go down, okay, based on this, we probably will go down to $18 and then we're gonna go bounce up. Now I will not expect Rocket will continue going down below that in the short-term period, okay? The way how I play this, I want to catch my position so I can collect the premium while my stock is taking losses, unrealized losses. Then whatever the premium that I collected, that at least will cover my losses a little bit, right? Now, if the Rocket will keep going sideways as I'm taking more premium, then it's a good play. And then eventually if Rocket goes up, then I will make money on the Rocket. Does that make sense for everybody?
Mm-hmm.
Okay. All right, now
Yeah.
let's go back to the slide here. Okay, we already talked about basic resistance and support. Option expiration. Most of the stock will have weekly option. Some stock will only have monthly or none at all. So let's say if you're talking about like a biotech option, or maybe any stock, biotech stock, or any stock that basically like a penny stock, they don't have any option. Or any small volume stock, they will not have any option because it's not liquid to move the options at all. Rocket IPO trading at 18, I expect to be support. We already talked about this. So if I estimate the downturn will last about 2 weeks, so I want to look about 7 to 14 days length DTE, day to expire. Now I'm gonna start looking on my thing or swim about 2 weeks roughly, 7 to 10 days between the price 22.30, which is the resistance, right, to $24. That's where the simple moving average. Now I'm gonna open my thing or swim. Remember, if you don't use these, you can choose to use other stuff. Now in my toss, because today is Saturday, when I did my research, it was back in Wednesday. So we had an expiration 9/25, September 25. Now, of course, now it's Saturday. 9/25 is already expired completely, right? It's already passed. Now we only have the option October 2nd. At the time I did my research, 2250, I'm sorry, not on the put, right here. 2250 right now currently is giving you about $20 on the bid and $25 on, I'm sorry, 25 cents, 20 cents on the bid and 25 cents on the ask. Now, as you go up more to 23 and 24, you're gonna see the option value, it become less and less. Do you guys follow me so far? Okay. Now, I have a screenshot here because if I base on this is not the the number that or the collected premium that I selected on Friday, okay? This one, let's go to this slide. This is the screenshot based on the Wednesday. As you can see, 23, well, I'm sorry, this is not on Wednesday. This is on Friday, late Friday, okay? But if you see the next slide, this is recorded on 9/23 right here on Wednesday. 23.50, it was giving me about 42 cents per contract. Now, if I'm selling 5 contract, remember I have 500 share, that means I can sell 5 contract. It's giving me about $210 if Rocket will expire worthless on October 2nd. And it will not breach 23.50 strike number. You guys follow me? Okay, this is how I choose my research. The break even for me, 23.50 plus 40 cents. So that's roughly about 23.90-ish, right? So that's close to the 24 simple moving average. If Rocket basically trying to poke that area, right? Now I have about 7 days, October 2nd, right? Now is Saturday. So I have technically 5 days, 5 business trading days. If within that 5 days and Rocket just goes sideways, up, down, I am collecting this 210. Well, technically it's not 210. This is just the screenshot. When I got filled, it was 32 cents. I'm gonna show you the next slide. Because I was doing research and then, I don't know, maybe my work had gone busy and then I forgot. And then when this is the screenshot of 925. I got filled at 32 cents right here. If you follow my mouse. Instead, 42 cents from the last screenshot, I got filled at 32 cents. So 32 cents times 5, it's equal $160. Remember I told you that the option value keep going down, right? So you gotta have to act fast or otherwise you're getting less and less value. Now, if you look at today's here on the thing or swim, let's say you choose to sell it on Monday, you're only getting about 10 cents on the bid and 15 cents on the ask. So we take the middle part, roughly about 13 cents, right? Remember the value, it keep decreasing. So that's why I'm telling you guys, if you guys play directional call or directional put, if Rocket doesn't go up to 23.50 call, then your value of your option is keep going down and you're losing money. Okay, any questions? So this is recorded at 9:25 in the morning, 17 cents or 18 cents. Now, if you look at the toss that we just saw, it was about roughly 13 cents, right? Now I gain about 72.50 roughly. Now, the morning on the 9:25, which is on Friday, oops, I don't mean that, 9:25 and 9:24, I bought another 100 share, okay, at 20.40. So that's why you see that, hey, I hedge 5 and I also have another 100 share that is unhedged. I haven't put any hedge yet. So I'm gonna wait until this is expired. Then if I want to hedge again, so that means I have 6 contract if I can play with. Does that make sense?
So can you sell this at any time?
Yes. So technically, let's say on Monday, I want to cover this. This contract, hey, you know what? I think Rocket will go up. I'm going to take this profit right now. I'm going to buy back. So remember, when I sell, they're giving me a credit, right? $160. Now, if I want to buy back, I only pay $87. based on this price, right? But of course, on Monday, the price will go down again. So technically, maybe I'm paying roughly about $50. So I'm collecting roughly about $110. Does that make sense?
Yeah.
Okay. Yeah, you can buy, you can sell anytime if you want to. Okay. So right now, based on this, I still have unrealized loss, roughly about $241, right? So let's say on Monday, if rocket goes up, then this number will keep going down, right? The losses will become smaller and smaller. And eventually it's profitable. I don't know if you guys watch my lesson number 4, I play oil. If you haven't watched the YouTube, that's giving me a net $5,000 just to play oil, because the way how I play the same strategy, I keep adding more oil as it's against me, but I'm selling the contract call, collecting the premium. Okay, now let's go back to the slide. Now let's go to the scenario. What happened, right? There's multiple scenario here based on your hedging. Scenario number 1, rocket keep going lower. By October 2nd, rocket closed at $18. So if rocket closed at $18, that means my hedge call that I hedge right there will expire worthless, and I'm collecting that $160 free and clear. You don't have to buy back. You just let it sit there, and then after that, the broker will automatically wash it the next week. Automatically will be gone, and then $160 it's on your pocket. Okay. Now I'm gonna put some calculation here. My buy average, it's about $21.15 on that 500 shares, right? Now 21.15 minus 18, so that means I have about $3.15 unrealized loss per share. So that means time 500, so roughly about 1,500-ish, right? But I collected $160. Now keep in mind, I put unrealized because I still have not sold the stock. So what can you do based on this scenario number 1? You can buy more, right, to average down your dollar cost, and you can hedge more. So when you want to hedge more, I'm not going to explain about average down. I mean, I'm pretty sure you guys, it's a straightforward. You just basically buy more than your 21.15 buy average to become less, maybe $20, depending whatever how many shares that you purchase. Now the hedging, now it's going to be the same thing, right? You just have to go to the technical chart and look at, okay, John, here is the last support, 1850, or this is the last low, 19 something, right? You can also draw another trend line here, and this is also your other resistance. You can also keep the same strike at 23.50, or maybe you can bring it a little bit lower at 22.50. So if you want to sell 22.50 right now, let's say you choose to be another week, right? October 9, 22.50, it's giving you 45 cents on the bid and 60 cents on the ask. So roughly, let's take the middle part, 50 cents times 5 contract. So you're collecting another $250 based on the number right now. Remember, if the time as is moving, this value will keep going down. Okay. Now, if you choose to be on October 16, which is 2 weeks, 22.50, 70 cents, and 80 cents. So 75 cents we put in the middle. Take in the middle, right? 75 cents times 5 contract, that will be roughly about $375. Okay, if you choose to roll over and selling it more, hedging more. Okay, let's go to scenario number 2. That's scenario number 1 if rocket move lower. Scenario number 2, rocket is moving sideways, regardless up, down, but it stay within the range. Now let's say October 2nd, rocket closed at 21. That means our hedge call 2350 will expire worthless, $160. We collect it free and clear. Now my buy average 21.15 minus 15 or minus 21, right? Because it closed at 21. So that means I have 15 cents unrealized loss. So time 500, so $75. So I'm collecting 160, but I'm losing $75 on the share. So that means net I am making roughly about $85, right? If you want to sell it, if you want to close your position. So if you close your position, you net $85. Now, or you can hold it, because in this case, I'm going to hold it not long term, but I want to see like how high this rocket can move at least back to $30. Okay. Now you can also do the same thing. If you choose to hold, then you can sell the call strike either with the same strike, the same expiration, or maybe 2 weeks or higher, right? Just in case if the whole market is making a turn, let's say by October 18th, market basically start bullishing again. Then you want to sell a higher call, not on the 2350 anymore. You want to sell it on 25, 26, it's up to you. That's how you have to learn the technical chart, okay? Now, scenario number 3, rocket is moving higher. So let's say by Monday, and then rocket start moving higher. October 2nd, rocket closed at 23. The hedge call will expire worthless. Remember, we have 23.50, right? So we're collecting $160 free and clear. Buy average gain, I'm sorry, buy average 21.15 minus 23 or 23 minus 21.15. So you technically have a profit on the share, right? On the stock itself, because it closed at 23. You technically now have $1.85 per share unrealized gain because you haven't sell it yet. So you're collecting $160 from hedging plus $1.85 point per share. So that's roughly about 800 something, if I calculate correctly. So technically in this play, you are making $1,000 just by having this play. So what else can you do? You gotta have to see the market. If the market keep pulling back or the market keep going high, you can hold your position or you can close your position. Or you can also do the same thing. Remember, this is the strategy that you can do. You can sell the higher strike. So let's say if you want to sell, I don't know, I'm just thinking out loud here. By October 2nd, rocket is closing at 23. And let's say I want to play more. I want to sell at, giving me some room. At least it can go up to 26, right? Now, right now, it's about 2 weeks away. Oh, I'm sorry, 3 weeks away because it's October 2nd. It's giving me about 20 cents on strike number 26. The price 26 right here. 20 cents times 5, $100. Not bad, right? Unless you want to choose a little bit longer, let's say you want to go back all the way to October 30th, and then you choose, I don't know, 26. That is giving you 35 on the bid and 50 cents on ask, right? About 42 cents. Okay. You can play that way too. I'm just choosing the number roughly, but if you want to look the technical chart, okay, resistance at 24, okay, our moving average will go down here, and then there's also another resistance maybe in this area right here, around 26.80. Yeah, that's a good resistance as well if you want to mark it
John,
up.
looking at your chart, the top straight line and the bottom red line.
Mhm.
So you're saying the support's gonna move up later on?
Okay, which chart you're talking about? This one?
Yeah, yeah, the one that you have open.
Well, I'm just drawing from this low to this low. If
Okay.
I'm thinking, hey, if rocket only move this low, and then eventually next week the whole market will start bullish, then this is will be the high. I'm sorry, the low and high, right? So that's considered as another support eventually. Now, of course, if the rocket will go down, then this will not become a support anymore because it breached that low.
Okay. All right. Thanks.
Okay. So 2680, that will be the resistance right there. If you want to sell, let's say rocket close at 23 by October 2nd next week, then you can also sell 27 right here. That will be the safe play. Now, remember, you keep collecting premium as it's moving high and low, high and low. Okay, let's go to the scenario number 4. This is where the problem is. Scenario number 4, suddenly there's a news, rocket explode higher, right? It can happen. You never know. Sometimes the news can make such a big move, right? Rocket closed at $30 by October 2nd. Gosh, my hedge call is become lost now, right? But my stock is making money. So let's do a calculation here. Hedge call price is higher. Remember, you're collecting about 32 cents. Now it's become $6.50. You're technically losing money, right? Yes, it can happen. How do I get $6.50 on the hedge call? $30 minus 23.50. That's the strike that you choose, right? So that means by October 2nd, your price of the option that you hedge, it's $6.50. Unrealized loss. Keep in mind, I'm saying unrealized because you haven't closed the position yet. Now I'm gonna give you a scenario what you can do with this, okay? Now $30, 23.50, and you also collecting about 32 cents, right? So technically about not $6.50 loss, but it's $6 and $18 per share.
Should you shouldn't that be collected a positive then instead of a negative?
Yes, good question. Eventually it will become positive. Here, let's do the calculation here. Now my buy average 21.15, $30 minus 21.15, my stock, the share that I own, is basically about $8.85 points unrealized gain. Now your net profit, okay, $8.85 minus $6.18, $2.67 points profit per share. So let's say in this case you have 500 share, you are making roughly about 1,300, if I calculated correctly. No, about $1,030. Let's put some calculation here. I have a bad math. 267, right? Yeah, about 1,300. So either way, this play is win-win for you, right? If you want to continue keep doing this is one of the play that I like to choose, especially when you have a good company. Now, keep in mind, what else can you do? You can also keep your stock or let it the share exercise. Exercise means the broker will sell your stock, your share, to the person that you borrow the option call, right? They're gonna own the stock and you're just gonna get out with the net profit. Of course, this is not a bad choice because if rocket by October 5th, or October 5 when the market opened, hey, you never know. Maybe rocket will go down again, and then you can buy it cheaper, right? So there's always a win-win situation here. If you choose to keep your share, right? You don't want to sell your 21.15 here for 500 share. What you do, you roll over your hedge call from 23.50 call strike to another higher strike and also a longer time frame to expire. In this case, you can choose, let's go to my toss here. Of course, don't think about the number, okay? The number will change eventually as the rocket price will go up to $30. You can choose the 20 October 23, and then you can choose, let's say, I don't know, $31 if you expect rocket will go down, maybe $35, because at the time at $35, this value will become, I don't know, maybe 50 cents or maybe become 60 cents. Keep in mind, if you roll over, that means you're selling the hedge call, realized loss, okay? Then you're collecting another premium again on the other strike and another DTE, day to expire. Does that make sense?
So hedging seems like a kind of a safe option to either cover your losses or it's more like a protection then?
It is. It is a protection. Keep in mind, if you hedging, keep in mind, you don't want to keep hedging all the time. If you know the stock will go up, might as well just cover your hedging, right? Buyback, or let it expire and don't hedge it again if you know the stock is it's making a turn back to the upside. Because if you hedge, you only limited profit. You're given only limited profit, right? Because if you let the hedging expire, let's say by October 2nd, the stock price is at $23. So technically you are making about a dollar, what was scenario number 3 here? $1.85 point, right? Per share. And then this is the best scenario that I can put in my mind right now. Scenario number 3, rocket close at $23. You're collecting your hedge call expire or list. That's great. And you're making money on your stock. And then Monday happened on October 5, rocket basically going higher to $25. You don't have any more hedging, right? So that means from profiting $1.85, you're basically profiting to $3.85. You have potential unlimited profit if you don't hedge. Does that make sense? Hedging is good when it's against you. Hedging is not good if the market is moving in your favor.
Okay, got it. Yeah, thank you.
You want to hedge only when the market downturn. You don't want to hedge when the market is going in your favor. That's what we want to cover in this topic today.
Yeah, I think if the stock is near its peak and but I mean you never know when it's near its peak, but like say for Workhorse recently when it was around $30, I sold the call for January 45 call and that was worth like $500. So
and now probably less, right?
yeah, so I and then it dropped, but I mean you want to try to sell the covered calls near its peak.
Yes. Now how do you know if it's peak or not peak? The way how I play my stuff, and keep in mind just to do the time check, we only have about 3 minutes before Zoom is shutting down on me. You have to look at the market day by day, right? You will see that SPY and QQQ, IBB, go back and watch my YouTube channel, okay? I look at all those indices as an overall. If they are basically overbought, that's where you want to do cover call. At least you want to hedge temporary, a week or 2 weeks. Now, of course, if the bear market come or the trend has changed from bull to bear, then yeah, the correction is going to be bigger. It's not going to be weekly. It's going to be months, right? So you want to sell the rip. Any questions? All right, I'm going to close it here. Thanks guys for participating. And if you haven't subscribed my channel, feel free to do so and click the like buttons.